If you're 62 or getting close, you're likely asking one of the biggest questions in retirement. Should I start claiming Social Security now or wait? It's a decision that can shape your financial future in ways most people don't fully consider. After years of helping clients navigate this exact choice, I've developed a clear strategy, one that helps maximize lifetime benefits, avoid common pitfalls, and position your income for long-term security. That's why I'm making this video, to walk you through the real impact of claiming early, challenge the conventional wisdom around retirement planning, and show you the key financial adjustments that matter most in this stage of life. Let's get into it. Hi, I'm Rob Bacharach, Certified Financial Planner, here to help you get the most ROI out of life and your money. So why all the talk about claiming at 62? Other than being the earliest age you can start, here's what's going on. There's been a lot of attention on the Social Security system lately, specifically concerns about whether the program can keep up with its future obligations. According to the latest Social Security Trustees Report, the trust fund reserves that were set up to pay for Social Security benefits could be depleted by 2034. That doesn't mean Social Security stops, but it does mean that the program would have to solely rely on revenue that it brings in during each year, which isn't enough to pay out the full projected benefits as we stand today. So the result, if nothing were to change, is that benefits could end up being reduced by 20 to 25%. Personally, I don't think this happens. I think more likely we're going to see higher taxes in the future to keep the system afloat, but that's a conversation for another video. For starters, let's break down the basics. Your full retirement age, or FRA, for most people is 66 or 67, depending on when you were born. I've popped a link in the description where you can check your exact date. Full retirement age is when you begin maxing out your benefit. But claiming before your full retirement age leads to a reduction. By claiming at the earliest, age 62, you'd receive about 70% of your FRA benefit. That's roughly a 30% reduction. On the other hand, if you wait until 70, the latest you can delay, you'd receive about 124% of your estimated full retirement benefit. So it's a simple trade-off. Less if you claim early, more if you wait. Each month you wait from 62 to full retirement age, your benefit goes up by about 0.5% or roughly 6.7% per year. Each month you wait from full retirement age to 70, it rises by close to 2/3% per month or about 8% per year. And you can see those numbers on the chart right here. So with all that in mind, how the system works, how benefits grow, and the uncertainty around future changes, you might still be wondering, should I just take the money at 62? Well, let's take a look at why some people do, and in certain situations, they're not wrong. There's a lot of advice out there saying to never claim early, but the reality is that's just not right. For instance, one reason that sometimes people do claim early and that it makes sense to do so is to offset withdrawals from their investments. Social Security can help reduce how much you need to pull from your retirement accounts to cover your necessary expenses. Here's a quick example. Let's say your Social Security benefit at 62 is $2,500 a month. That's $30,000 a year. You've taken the time to figure out that you need about $60,000 a year to cover your expenses, and you've saved up about $600,000. Without Social Security, you'd be withdrawing the full $60,000 each year from your investments, assuming you're retired at 62. That's a 10% withdrawal rate, and let's be honest, that's really tough to sustain for the long term. On the flip side, if you've saved $2 million, that same $30,000 of Social Security only reduces your withdrawal rate by about 1.5%. With $5 million saved, it's less than 1%. So sure, claiming early can take pressure off your accounts, but the more you've saved, the less impact that this has. And in fact, claiming early in these situations could reduce your opportunities for other planning strategies that we'll talk about in just a few minutes. Another reason that sometimes people do claim early, and it makes sense to do so, is they've been diagnosed with a serious illness, or they know for certain that they may not live a long life. And in that situation, it probably does make sense to start your benefits sooner because you don't know how long you're going to be able to receive those benefits for. So, those are some of the reasons that it does make sense to claim your benefits as early as possible. But before you make that decision, it's critical to understand the risk, because once you start, it's almost impossible to undo the long-term impact. The most common risk of claiming early that you may have heard of, permanently locking into lower benefits. This will lead to significantly less total income from Social Security over your lifetime. And if you're someone with one spouse having significantly larger Social Security benefits than the other because one person maybe stayed at home and the other was the breadwinner, this difference is even bigger and it makes the decision even more important. Let's take a look at a quick example. What we have here is Frank and Joanna Miller, who we're going to look at their situation again in just a few minutes. Frank and Joanna are deciding when they should take their Social Security, and what we have here on the chart is the total cumulative benefits, current strategy being taking it at age 62, or they wait till age 70, or full retirement age. And you can see here, since Fred has significantly larger benefit than Joanna, Joanna's benefit would be around half of Fred's. We can see here that their current strategy, with an estimated living until age 95, would yield $1.3 million. But just waiting until full retirement age could yield Fred almost an additional $400,000. On Joanna's side, it's an additional almost $150,000 or $60,000. So between the two of them, you're talking a difference over their lifetime of about $500,000. So there's no doubt that waiting longer will yield you more benefits over the course of your entire life, assuming that you live at least until life expectancy. What the chart is telling us here is that using the current strategy is best if we think we're going to pass away before 76. Full retirement age strategy is best if we think we're going to live between 76 and 80. And using an age 70 strategy would be best if your life expectancy was 80 or longer. And so in a vacuum, this chart right here can help tell us which option is best. Wait longer, get more benefits, live longer, get more benefits. It's an easy answer. But the problem is that there are so many other factors to consider. Thanks for joining. If you're enjoying this video, don't forget to hit that subscribe button. Thanks a lot. Now, let's cover some of the more uncommon pitfalls and misinformation about electing early benefits. The other day, I had a client send me a video of somebody posting on YouTube or LinkedIn, essentially saying, just take your benefits early. It doesn't matter. Even if you do take it early and they're reduced, you'll get some of the money back later. And in a way, what the individual was saying is correct. Their idea being just take the benefits early, even if you're still working, and just go reinvest the money. But they left out a really, really critical point that is likely relevant for most people still watching this video. And the point that they left out is that when you elect your benefits early, under the idea that you're just going to take that money and go reinvest it because you think that you can do better on your own, they're forgetting that while you're still working, your benefits are reduced $1 for every $2 that you earn over a certain limit. 2025, that limit is $23,400. So for every dollar you earn over that amount, the early benefits that you could claim would be reduced by $2. So what the individual failed to mention is that if you were earning any significant amount of money at all, say $85,000, $100,000, your benefit would be reduced to zero and you wouldn't even have the option of claiming early. Let me show you exactly what I mean. For this client, I logged onto the Social Security website. I went into the calculator that I'm dropping a link for in the description below that you can check out as well. I plugged in his date of birth, his earnings for this year, and some other really quick information. And this is what the system spit out. No benefits can be paid to you because your earnings are too high. Calculation details, your earnings in excess of the $23,400 exempt for 2025 or $85,000 less, $23,400 is $61. We withhold benefits, $1 for every 2 in excess. The excess earnings divided by 230, which exceeds your annual benefit, meaning you get zero money. So when you're trying to decide if you should start claiming benefits early, even though you might still be working, keep this in mind. Depending on how much you make, you may not be able to claim any benefits at all. There's another point that this individual also failed to mention. Earlier in the video, we said that Social Security benefits from age 62 to full retirement age compound monthly at about 0.5% per month or 6.7% per year. From full retirement age to age 70, they grow at about 8% per year. Well, 6.7, let's call it 7% or 8% per year, is nothing to scoff at. That's some pretty decent returns. And what you have to recognize is that if you're going to claim those benefits early, you don't get to reinvest your full benefit amount. You only get to reinvest your benefit amount after taxes have been withheld and maybe even reductions because you're still working. And so in order to actually even do the same as or beat Social Security, you have to beat the guaranteed 7 to 8% that Social Security is going to give you before taxes. So we're talking maybe 8 to 9, 9 to 10% to equal the same end result that you would be getting guaranteed from Social Security. That's a tall order. So just keep that in mind when the idea of taking your benefits and just reinvesting them comes up. Social Security growth is guaranteed. The market isn't. Finally, there's what I call the tax domino effect. Claiming early means more income sooner, which can cause more of your Social Security to be taxed. Could also increase your capital gains tax rates and raise your Medicare premiums. Not to mention, it definitely can impact your opportunity for Roth conversions. Claiming early could cost you tens, if not hundreds of thousands of dollars over time. The simple difference between total benefits over time, that's one thing. But there are so many factors to consider that could make a massive difference. And so before we wrap up, let's look at a final few quick examples. The first column that I want to show you here is a situation where Frank and Joanna Miller are in retirement and they chose to sell an investment property. Their capital gains were about $200,000. They were deciding whether they should start Social Security or not, and if they did, how much that would impact the taxes that they would owe on their capital gains. So you can see here that if they had no other income except for the capital gains coming in for that year, their total tax would be a little over $11,000. Well, if they did decide to take Social Security that year, we can see in the next column, we're going to add $40,000 of Social Security. The taxable portion of that, because of the capital gains, are $34,000. This adds to their total income, and we can see in just this one single year, this decision is costing them a little over $5,000. Compound decisions like that over the long term, and that could make a huge difference. To the flip side, let's see what the impact looks like if there was no capital gains and they only had their Social Security income. This one might surprise you a bit. In this situation, if the only income that they had was their Social Security, because they were taking maybe distributions from a cash account or CDs, something like that, and they only had taxable interest, you can see here that the only interest they have is $5,000 of taxable income. Because of standard deductions looking forward, we can scroll down here and see that without those capital gains and starting Social Security, they actually owe zero taxes on that income, which is pretty cool. So look at one more example. Let's talk about Roth conversions here. In this column here, we're talking about doing Roth conversions at $150,000 in the current year without having Social Security income on top of that. So we do the Roth conversions where we withdraw the money from the account, we pay taxes, we move it over to the Roth IRA. We can scroll down and see here that the estimated total tax on that Roth conversion is about $16,000. In the same situation, if we plug in $40,000 of Social Security income, this really drives up the total taxes due on the Roth conversion. So we can come down and see here in just this 1 year, starting Social Security early causes an additional $8,000 in taxes. What we just looked at was the impact over only a single year. When we factor in these same types of decisions happening year after year for 20, 30, or 40 years throughout retirement, the total impact towards taxes or the amount of money that you end up with at the end of the day can be massive. It's extremely important to take the necessary precautions and work with the right people to find the right answers and construct a proper plan that fits your unique needs. So here's the takeaway. Claiming Social Security at 62 isn't always wrong, but more often than not, especially for the folks that are probably still watching this video all the way to the end, it may not make sense to claim it early no matter what you hear online about those contrarian opinions. At the end of the day, this decision has lifelong consequences that affects not just you, but also your spouse, your taxes, and your future flexibility. If you're feeling overwhelmed by this decision or any other decisions about retirement, you're not alone. Social Security is complicated, and no one should have to guess when it comes to their retirement income. If you're interested to see how we might be able to work together, there's a link in the description that you can click to schedule a time to chat. Until then, thanks for joining us. Don't forget to hit that subscribe button, and we'll see you next time.